Hello, and welcome to another edition of the Rousseau Report. I'm your host, Dennis Rousseau. Too often we hear bold statements about the state of the economy, geopolitical issues, inflation, aircraft markets, and the like. However, after these potentially harming statements are spewed, rarely are they revisited to test their honesty or accuracy. In October of 2021, less than a year ago, we produced session 34, titled Unprecedented Markets. And I must say, we received overwhelming praise, with some saying, why can't the mainstream media report these facts? Which is another subject in itself. So, for the next few minutes, let's take a step back in history. That's 1776, the Declaration of Independence. Too far. A DC-6 from the 40s, about 9 months ago. And then we'll see if what I said played out. If you recall, we used a 1991 G4 to demonstrate the higher costs relating to aircraft age. Further considering the fact that aircraft are depreciating assets, this vintage model, at 31 years old, should be in the parts bin, as the cost to maintain it far exceeds the value. Plus, the airframe and avionics are no longer supported by the respective OEMs. 36 aircraft have already been written off, and that list is constantly growing. So we have available parts to support the remaining fleet, but yet there are 7 G4s on the market, and as you can see, our current values for these aircraft are exactly where they should be: salvage value or the sum of the parts. I would dare anyone to get a quote on unrolling the engines on corporate care with over 10,000 hours on them. In the first 7 months of 2022, there have only been 4 transactions, compared to 14 transactions, G4s now, for all of last year. You may as well be buying and selling G2s and 3s, because that's where we're going. Lest we forget the exorbitant costs for the next major airframe inspection. Prices every year. The corrosion we're now finding on current generation models, 10, 15-year-old aircraft, grows every year. And what do you think it looks like on a 30-year-old aircraft? You've heard me say this many times. Just prior to a recession, we see an uptick in selling prices, not value. Value will be frozen in time until the market corrects to some semblance of normalcy. In the case cited last October, we used a 1995 G4SP. And from 2019 to 2021, the 4SP selling prices increased $500,000, or 17%. Now keep in mind, I said there's an uptick in selling prices prior to every recession. Fast forward 2022. 1995 G4SP selling prices are averaging $5 million, up 66% since 2019. So as not to pick on 4SPs, let's see how a 1998 Challenger 604 has fared over the last 3 years. Son of a gun, up 60%. The question buyers should be asking is, where would the prices be for these depreciating assets without this run-up? The answer, just north of $2 million. Even newer current generation aircraft are seeing upticks. Whether it's a 2004 Gulfstream G550 or 2004 Falcon 2000 Easy, up 38% and 35% respectively. Now, to those that pay these inflated prices, you're probably lauding yourselves, taking a victory lap. I wouldn't just yet. Wait until you see the facts of the markets through the first half of 2022, coming up in just a minute. Let's first review precursors that signal a recession. In that same presentation last October, I made the statement that the IMF announced in March of 20, which they did, that we were in a global recession. The National Bureau of Economic Research, the ones that call our recessions, officially declared a recession in the US in June of 20. Now here we are 2 years hence, and there's all this chatter questioning whether we're in a recession defined as 2 consecutive quarters of negative GDP or growth. Q1 22, negative 1.5%. And although the official rating won't come out until the 28th of July, the Atlanta Fed's model puts Q2 growth at minus 1.5% based on available data through July 15. Now, geez, how could this data possibly turn from negative to positive in 1 week with our current administration? Perhaps to fit a narrative like, what recession? Or as Squirry, the current CEO of Amex, just stated, I don't see a recession in my numbers at all. Well, perhaps you shouldn't take such a myopic view. The S&P is in a bear market defined as a decline of 20% or more. I know a good deal of people have the propensity to have short-term memories. So let's take a quick look at history and see the corollaries. The recession that began in 1973 was due to the quadrupling of oil prices. 1980 to 1982, Iran was the fourth largest producer of oil, and once the Shah was overthrown, oil was exported at lower volumes, forcing prices higher. Plus, inflation and the prime rate reached 20.5%. Let's look at this fundamental a bit closer. Near 21% for the prime interest rate. The gray columns indicate a recession. Now look what happens to interest rates just prior to and directly after. It's quite a corollary, and yes, today interest rates are on the rise, which I'm going to circle back to in a moment. The Gulf War, 1990, resulted in an increase in the price of oil. NAFTA started, which moved manufacturing out of the U.S. And the leveraged buyout of United Airlines triggered the stock market crash. In 2000, we had the collapse of the dot-com bubble, which sounds pretty close to cryptocurrencies. Then accounting scandals involving some of the highest profile companies of the time. And of course, 9/11, which shook the world. The 2007 recession devastated global financial markets and real estate industries. Millions of people lost their savings to the tune of $14 trillion. Jobs and homes were lost as a result of the subprime mortgage crisis, similar to the stock market decline recently that wiped out $3 trillion in retirement savings. Then, of course, we had the too big to fail companies, where the government dumped billions into them. AIG, $85 billion. GM and Chrysler, $80 billion. Bank of America, $125 billion. Then the new administration ratchets up another $780 billion through a so-called stimulus package. Keep spending money we don't have to support some political narrative. Now comes the best part. Interest rates were at 5.25% in 2008, then continued to drop, and what did people do? Sounds similar to recent times. Now remember, prior to a recession, interest rates rise. Post-recession, they fall. As mentioned, oil prices spiked to record highs in 2008, then crashed, crushing the U.S. oil industry. Time and again, we've seen that oil price swings have been precursors to recessions. Another impact rising prices have is that on Jet A, or jet fuel. The cost per barrel has been fairly consistent since 2015. Then a new administration comes in and destroys commercial travel, as they're forced to absorb higher fuel costs, airlines that is. Then they pass it on to the traveling public, and speaking of the public, in October of last year, we showed you the chart on the left, where the price of regular unleaded gas was $2.18 in 2019, then $3.28 to $4.14 in 2021, to the highest on record June of this year at $5 per gallon. Due to the multitude of factors, not only have new car prices gone up to an average $47,000, but now used prices had unprecedented increases amounting to just slightly under the cost of new. A day doesn't go by when we hear from our illustrious government, buy an electric car for $70,000. Yeah, you're going to pay twice as much in insurance. Sure, and I believe we've all heard the story where a 17-year-old's parents bought her a 2014 electric Ford Focus with 60,000 miles for $11,000. She had the car for 6 months. The battery went kaput, then she found out it would cost $14,000 to replace it. Sounds very similar to a 30-year-old business jet. The problem was Ford discontinued the car and the battery. It was considered junk. Then, of course, the Wall Street Journal reporter who drove from Louisiana to Illinois, what should have been a 2-day trip, took 4 days as the majority of chargers en route were level 2, meaning it would require 8 hours for a full charge, not to mention the wait time for a charger. Speaking of which, this is what the line looks like at a charging station in California. Another dynamic to look at is the stock market. When we provided data last year, the US 30 was still climbing, but today it's just shy of 31,000 from its peak of 35. And once again, what happens prior to a recession and post-recession? Now let's circle back to housing markets for a moment. Then I'm going to show you the data on business jets I mentioned earlier. In 2021, as I said in our presentation last year, we were selling around 7,000 homes per month. Although in the video, if you catch it, I said 7 million. Anyway, we're down to 5,500 per month. Homes are not being scooped up without inspection and sight unseen. Days on the market around the increase in price drops are increasing. Once again, a telltale sign to a recession. And when we have high prices with increasing interest rates, the average home buyer is faced with affordability, where interest rates drive the monthly mortgage payment beyond affordability. As of this week, the average APR is 6% and about to rise further to coincide with another rate increase. The median sales price in 2020 was $320,000. As of April this year, the median sales price for a home had increased 30% to just under $430,000. Couple this with higher interest rates and prices have to come down. Another dynamic in our equation of factors leading to a recession is the Consumer Price Index, where we just hit the highest in 40 years at 8.6%. Keeping in mind we're at 1.5% January 21. Look at the CPI prior to and post-recession. Now keep in mind the CPI the government uses does not include energy and food. Previously, we showed you a 22% year-over-year increase in regular unleaded gas. Cheese and milk are up 36% year-over-year. Rice 25%, butter 83%. Eggs 235%. Salmon 81%. None of these are 8%. Add them all up and we're well over 20%. In July of 2010, commercial office space had a 17% vacancy rate. In 2021, it rose to 18.4%, and less than a year later, we're over 30% in major markets and climbing. A number of our clients who are in the commercial real estate business have all stated the reported numbers are on the low side. Another fundamental that's knocking at our back door is consumer debt that rose 10% in just 1 year and continues to climb. Now let's see how all this affects the business jet markets. Courtesy of AircraftPost, they compiled the following first half market statistics for all purpose-built business jets since 2015. And you'll notice a couple of things. First off, transactions show a year-over-year increase up through 2020. Then in 2021 and 2022, we see a 13% drop and 44% respective decrease in transactions. But the most important dynamic in these statistics is for the first time in 7 years, aircraft brought to the market exceed the number of transactions, which are better depicted in graph form. Now, what does all this mean? We're about to see some real change in what buyers are paying. Increased inventory and decrease in the number of transactions has always pointed to lower pricing, whether it's used cars, houses, or business aircraft. AV Web recently ran a poll asking if high fuel prices have curtailed flying activity. 59% of the respondents clearly indicated a drop in activity. Where do we go from here? Stay tuned for our next session. Until then, I'm Dennis Rousseau for the Rousseau Report. Thanks for tuning in. Have a great day.